Are we seeing signs of losing momentum or going backwards? Which one is it?
Good morning, John. I think it's losing momentum for now. And we're losing momentum for good reasons. People are engaging less. Businesses are shutting down because health conditions have deteriorated. To go backwards, you need a major shock of some sort. It could be a policy mistake. It could be a market accident. But I don't think we're going backwards. I just think we're slowing down and we're going to level off in terms of the recovery. Just remember the square root, which I think is where we are right now in terms of economic activity.
Well, let's talk about the policy decision in front of us right now down in Washington. Mohamed, what would you consider a policy mistake as they put this bill together?
Underestimating the scale and scope. You and Kevin just had a really good discussion about relief. But if you look at what the economy needs, it's 4 buckets, John, not one. It is relief. It is making sure that we can live with COVID, because that's what we're going to do for a while, in a healthy and economically productive fashion. It is about countering downward pressure on long-term productivity. It's about countering downward pressure on household economic security. People are feeling insecure. Unless you move on all 4, we're going to have issues. So I think that the scale and scope is so complicated that at best we're going to have a partial solution, but they're going to need to go back to work pretty quickly.
Mohamed, the uncertainty is in this market right now. Gold approaching a record through 1900 for the first time since 2011. That's dropping across the Bloomberg terminal at the moment. Real yields deeply negative. A dollar that's breaking down, gold that's breaking out. Mohamed, could you weigh in on the market dynamic playing out before us?
Yeah, despite all that, John, the marketplace is comfortable buying every dip in risk assets. And the disconnect with the real economy, the disconnect with policies is getting bigger and bigger. But you've got to respect these technicals. They, at some point, are going to run out of steam. No one knows when. I, for one, was too cautious, and I acknowledge it, but I don't feel like re-engaging at this high valuation. But you've got to respect the technicals. This buy on dip mentality has become so deeply embedded that you really need a major shock to counter it.
Mohamed, if we do stall, if this recovery does go backwards, where's the risk in this market? Because the crowded areas of this market right now are the safer areas of this market. It's in investment grade, gold, which has performed terribly well through 2020 as well. These are crowded areas. In a lot of people's opinion, growth stocks in the United States as well, Mohamed. If you think there's a risk that we roll over, where's the risk in financial markets?
It's everywhere except if you're under the central bank umbrella. Unless you have a very big balance sheets behind you, there is a big risk of price gapping down. So it's everywhere, John. I wish I could say something different, but even the safe assets, even the names with very strong balance sheets have been taken to such high valuation that unless they're under the Fed umbrella, which is investment grade bond and certain high yield bonds, the downside is considerable at this point.
Looking at dollar yen this morning as well, a break of 107. We have been at 107 for the last 7 months. We're flirting with a 105 handle at 106.09. The dollar increasingly in focus here, Mohamed, and for a good reason as well. The dollar started to break down, and I'm wondering if the data breaks down, how the dollar responds to that, because typically if the United States is not doing well, the world's not doing well, and the dollar gets a bid, that haven play starts to come in a more powerful way. Do you think it will this time around, or is the reaction function of investors starting to develop in another way?
So it's tricky, John. You know, the number I look at every morning is the interest rate differential between the US and Germany. That's down to 104 basis points. Do you remember how high that used to be? It's come all the way down to 104 basis points because the US no longer dominates Europe in terms of economic outlook. And that is a major change. Europe is getting its act together. The US, unfortunately, is allowing health issues to contaminate the economy. So it is getting more complicated in terms of what it means for the dollar. I, for one, as you know, no longer believe that the US dominates Europe in terms of valuation. I used to for a long time. That has changed. And I'm not as comfortable about a dollar strengthening as I was earlier.
Where are you a bit more comfortable?
So, look, we've got to be very careful. Look at the Mexico number today. it has flown completely under the radar screen. But Mexican GDP in May economic activity contracted by 22.7%. What we are seeing now is the direct impact of COVID on the developing countries after they've had the indirect impact. So I think relative trades in this environment are a lot easier than absolute trades. There's clear differences in cycles, and that's not reflected in markets as yet.